panelists, ladies and gentlemen, good morning, good afternoon, and good evening. Depends on where you are around the globe. Welcome to this important event. It's one of the highlights of the World Investment Forum's 95 events in partnership with over 60 institutional partners worldwide. Since its establishment just over a decade ago, the UN Sustainable Stock Exchanges has worked with stock exchanges and the market participants to support their efforts to contribute to sustainable development and achievement of the Sustainable Development Goals. For many years, though, the SSE did not examine the role of derivatives markets. And this began to change in 2018 at the last World Investment Forum, where we held a joint session on this topic with the World Federation of Exchanges. These conversations continued until 2020, when the SSE, in partnership with the World Federation of Exchanges and the advisory group leadership of the Chicago Mercantile Exchange, now we have Owen here, initiated a major project looking at this topic specifically. And this work was supported by derivatives exchanges and other market participants from around the world. It resulted in the publication in 2021 of our guidance, setting out how derivatives exchanges can promote sustainable development. To build on this work going forward, we are establishing a derivatives network within the sustainable stock exchanges, which means that derivatives exchanges are now welcome as full members of the Sustainable Stock Exchange Initiative. And this is a major milestone for the SSE as we deepen our promotion of sustainable finance to all parts of the exchanges community. So welcome exchanges to derivatives exchanges to SSE, and also thank you for the support of Owen and the Chicago exchanges. Today's session starts with the recommendations of the SSE WFE guidance and explore what exchanges and other market actors are doing to promote sustainable development, what they see as the role of derivatives and derivatives markets specifically, and how they see this evolving over time. Before I conclude, I wish to thank Anthony Miller, who has been leading the team of the SSE and pushing forward the collaboration with derivatives exchanges. I now now it's my pleasure to hand over to Richard Metcalfe, head of the regulatory affairs at World Federation of Exchanges, for moderating this important session. Thank you very much.
Thank you, James, and thank you for that kind introduction. It's a great pleasure to be moderating this panel. I'm not quite the deep expert in ESG matters that you have before you today, so you're in good hands, and I'm going to let them do a lot of the talking. I've done a lot of work on derivatives in my career, a lot of work. But the striking thing has been how much has changed in the relatively few years since I was focusing pretty much exclusively on OTC derivatives. There's a real sense of coming together and a real sense of awareness, I feel, particularly in the exchange community now, that this is where a lot of the action is going to be, not just until COP26, but as we all know, over a much, much longer time frame. And that introduces its own challenges as well. But I think what the report itself says, and I'm going to hand over very soon to Siobhan Cleary to talk about that, but I think what the report says is there are all sorts of people coming at this from all sorts of angles. Sustainable commodity derivatives are a natural place to start if you talk about sustainable derivatives, but it will become clear over the course of this panel that we are talking about equity, perhaps slightly less so bonds here, but potentially why not? One day maybe we'll have green credit derivatives or whatever it might be. And I think that the other thing that the report illustrates is that the best thing that exchanges can do is be exchanges, do the classic things that they do, bring together people, work in partnership with other bits of the market. These are all set out specifically as standards, good practices, objectives for exchanges, bring products to market, bring data to market, because we all know that data is crucial to the ability of the market to operate. And that's how market participants make money as well. And we have to factor that whole side of things in. So it's going to be an interesting debate for me. When I started at the World Federation of Exchanges 3 years ago, I was fortunate to have a colleague who was all over ESG. I've been learning a lot more about it since then. But I think we're all learning. And in that spirit, I'm going to introduce my panelists and ask them to get on with the nitty-gritty of this. In the order in which they appear on my screen, which will just make it slightly easier, we have Walt Lucken, who many of you, I'm sure, will know and recognize as President and Chief Executive of the FIA, a global trade association operating in the derivatives space, particularly the listed derivatives space. We have Owen Johnson, who's Global Head of Research for CME, Chicago Mercantile Exchange, if you prefer, and heavily involved in the steering of the report that is now out. You have Carl Edwards, who's a Senior Director of Market Policy for SIBO, based here in Europe. We have Siobhan Cleary, my former colleague at the World Federation of Exchanges, now Senior Specialist with UN Sustainable Stock Exchange, and a major driving force in the report, and indeed other reports on the topic of sustainable commodity derivatives, not least one published by the WFE a couple of years ago. We have Harry Cho, Head of Sustainability and Sustainable Finance for SGX in Singapore. We have Zubin Ramdashan, Head of Equity and Index Product Design at Eurex. They're neatly illustrating my point about how we're not just talking about sustainable commodity derivatives. Kyle also. I would like to get things rolling properly by asking Siobhan to expand a little bit on my very sort of sketchy high-level comments about what the report is about and what it represents. Siobhan, would you like to just set the scene for everybody and provide a platform for the individual exchanges to comment on in terms of what was going on with that report, how it came about, the gap it fills, and why it's so important to focus on derivatives? Siobhan, over to you.
Thanks, Richard, and thank you for that scene setting. I think that's great. So let me begin with the report. The report, as has been mentioned, was a joint product of the SSE and the World Federation of Exchanges under the advisory committee leadership of the CME, with very strong input and guidance from derivatives exchanges and other market participants, including the FIA from around the world. And really what the purpose of this report was an attempt to sort of build on the work that Richard had just referred to, which was an initial piece of work that the WFE had done in 2018, trying to sort of feel at the edges of what is this sustainability thing in the context of derivatives markets. And we were focusing specifically on commodity derivatives at that time, trying to map out how sustainability plays out in that space. And James mentioned the event that we held in 2018 at the World Investment Forum, and Owen was actually corralled into participating in that event. It's the first time we met and started this conversation. And really what happened then in 2020 is we decided it was time to sort of take a look at this again and to see where we were with the derivatives and sustainability, and to see whether there were opportunities to expand the WFE and the SSE's thinking about what role derivatives markets specifically could play in supporting sustainable development. Now, at the time that we started looking at this topic in 2020, there was really nothing other than the 2018 report that had been formally written on this topic. By the time we published in 2021, there were at least 2 other formal papers, one from ISDA, the International Securities Derivatives Association, and another from the FIA. And actually, the regulator of commodities futures markets in the US had also done a piece of work looking at climate change and in the context of commodities markets. So we went from sort of nothing to quite a lot in the space of a year. So really, going to this report specifically, we were trying to do, I think, three things. First, there was a bit of market education. And this meant that we were trying to really sketch out, as Richard alluded to, what were derivatives markets? Because before you can start to talk about derivatives in the context of sustainability, you had to really unpack what is it that derivatives specifically bring to the party as distinct from other asset classes or other product types. And then we had to sort of look at the ecosystem in which derivatives exchanges specifically operate. So that was the sort of scene setting for this paper. You know, what's the entry point for these types of actors and product sets? And then, as with all SSE and WFE papers, or with many of them, we then looked at, well, what's happening already? Because there was a certain assumption that, well, this is an entirely new area and we're sketching this out. But as we started to dig into it, we discovered actually that there were quite a few things that exchanges were already doing. And as Richard mentioned, those spanned from sort of energy, I'm going to call them energy products, sort of carbon credit type products and other, through to equity derivatives and index products, through to some of the more sort of classic stuff that exchanges do around driving standardization, helping to drive conduct requirements, etc. And then taking all of that together and some of the other work that was being done concurrently, we then said, well, how do we come up with an action plan that allows all derivatives exchanges to think about where they might be able to play a role in the context of supporting sustainable development? And we identified, I have to look at my list now because there are quite a few, 6 areas where we said exchanges could play a role. And the idea of being sort of quite broad with it was we wanted to create an entry point for every exchange. We didn't want this to be something that was specific to a particular sort of derivative class or derivative product type. And also we wanted to give exchanges that were sort of newer to this area opportunities to start to look at what they might do. So you can see the full report, it's online, it's been, it was published formally in April, but the gamut of action items that we have include engaging in partnerships. So that's around building sort of multi-stakeholder dialogues and partnerships to build consensus around what sustainable finance means in the context of derivatives markets, driving standardization, and we can get a bit more into why that's quite important. Enhancing transparency, I mean, that's central, as Richard said, to what exchanges and markets really do. Tying market participation to sustainability, and we've had examples of exchanges both at CME and LME where the participants have to meet certain conduct requirements in order to be part of the market, or the products they deliver into the market have to meet certain requirements. Introducing of ESG data products. I mean, data is what makes markets work and makes them operate. And then again, core to what markets do and how they operate, listing of tradable products to support the sustainability transition broadly defined. So I'm going to stop there.
Thanks very much, Siobhan. So that's the higher level scene, and I think what is really helpful there is the point about being inclusive. I think we all have a lot to learn from each other, as I was saying before, and that there's plenty of room for people to bring their various contributions to the market. And I suppose to see what works. Owen, is that a fair description of how your average derivatives exchange would look at these things? You've got a particularly close proximity to this question, having been so heavily involved in the paper. So you may wish to expand a little bit or offer an alternative perspective. But I'm interested to hear what it's like on the ground, putting this sort of stuff into practice and building on it in an environment where perhaps everybody can bring slightly different things to the table.
Yeah, I mean, CME remains extremely proud of this report. Sometimes when you issue a report, you put so much effort into it. You hope that people are going to read it, that you hope that people are going to use it, because, you know, it's kind of like delivering a child. And then I think with this one, we've been really, really pleased with the reception. So many of our customers have asked us to share a copy of the report, or we've sent it out as an introduction to what we're doing. I think the circulation it's got has been really tremendous, because I don't think there's anything like it that gives you that quick overview of what everyone's doing in the sector. So if I'm an asset manager sat in Europe and I just want to know what's happening, I really think this report has been the best place to start. So it's been an absolutely invaluable resource for us and for the customer base. So I think that reception's been great. I guess what I take from it, looking back at it now, is how many new products and developments there are just since we put the report out, which is just a few months ago. And this market for ESG and sustainable products is moving so quickly that we would have several new sections now with new products, new services. We've got ourselves voluntary carbon doing really well since we launched that. We've got sustainable clearing offering as a service that we've launched since that. So just you see that you can take a snapshot in time. But again, what's really gratifying is that the snapshot we took was of the exchanges stepping up. I think that's fair to say. And we've not seen any step back. We've continued to see exchanges step forward and launch more things. I've talked about a couple of things we've done, but plenty of our competitors and colleagues have done other launches since then. So it's really a market in motion. I think that's what's really gratifying about it. We hope that this will be a call to action, and it really has been, because we are seeing the evidence of that in all these new developments and launches.
It's always good to hear one's timing is spot on, riding a wave. Why don't you talk a little bit more about those two things that you mentioned, because I dare say there are plenty of people in the world who understand what sustainable clearing is or might be, and carbon offsets, but to the casual observer, somebody might say, well, what's sustainable clearing? Isn't that just clearing sustainable products? I mean, and maybe it's as simple as that. Maybe it's just identifying a way of helping those who want to work in a sustainable way to do it. But are there other aspects to it as well?
Yeah, so I mean, you've captured half of the concept, which is a lot of people are obviously clearing a lot of sustainable products, like the carbon offset futures that I mentioned before, very obvious, European emissions. So those are things, maybe the S&P ESG 500, those are things that obviously have a sustainable or ESG frame, easy to categorize. But then there's a whole class of work that our industry is doing to support sustainable businesses that haven't previously been captured. So if you imagine that you're hedging on behalf of a wind farm producer or a hospital or a solar panel manufacturer, but you might be hedging there with interest rates or foreign exchange products. You weren't previously able to call out the sustainability of those products. So what we've done is create a mechanism whereby you can tag not only sustainable products, but sustainable entities, sustainable accounts, and that we can then review that in accordance with the UN sustainability goals and ensure that you are doing what you say you are, but also ensure then that you're measuring across banks or across customers or across clearing members to make sure everyone's measuring in the same way. So what we provide is kind of an external validation and review service, but also by holding people to account with those external standards, we're able to show that the industry is doing more than just clearing carbon offsets. They are also helping the real firms in the real economy do their business and risk manage.
Yeah, with their real world tasks and requirements. Maybe there's a lesson. Maybe that's the next paper. Maybe we should focus more on clearing. One thing which I think, and I don't think it's a criticism, but we didn't really spend too much time talking about the clearing dimension. But the clearing clearly is important because that underpins the market in a way in which, as we've seen in the past, bilateral post-trade doesn't always work as well. And I would imagine that part of the appeal is also going to be that sense that we are largely here, not just in your case, I mean, but across all of these exchanges, we're talking about a situation where you can provide that extra level of reassurance in a market that is still developing and where you may get a wide variety of participants of varying degrees of creditworthiness. Is that a fair comment as well?
I think that's absolutely right. People are the worst possible thing to accuse anyone of in this sector is greenwashing. But you know, that's the absolute worst. It discredits everything everyone's trying to do. So the more that exchanges can help, and as you know, we're all very good at standardization, we're all very good at bringing buyers and sellers together and agreeing on standards and agreeing commoditizing products, if you like. That's what we do. So the more that we can help with that, I think the more we reassure people. And then the market has a potential to explode because, as you say correctly, there are a lot of people standing on the sidelines waiting for standards to emerge or waiting for it to pass whatever internal test they have. The exchanges, with their great credibility, can play a really key part in that, I believe.
Okay, we'll maybe come back to carbon offset markets in a little while. I'd like to give a few other people a crack of the whip. Harry Cho, could I invite you to come in at this point and talk about what you're doing and explain a little bit of the role of climate impact exchange as well, which is out there as a sort of a brand name we should get used to, I suppose. And by all means, feel free to add comments on the report itself, or just focus on what you're doing at SGX and why your focus is.
Sure, thanks for that, Richard. Of course, we were also delighted to help contribute towards the report and obviously support the report and the recommendations. And perhaps then I will spend more time in just sharing a little bit more about what we're actually doing that actually touches upon the recommendations of the report itself. So perhaps I can start with that broad perspective on how we're looking to drive sustainability and sustainable finance initiatives at Singapore Exchange. We have set a goal and a target to become a hub for leading sustainable, and very importantly in this part of the world, as with anywhere else in the world, but in particular in Asia, credible transitions, both in the financing and trading. And it's important that we pull together product solutions and very, very importantly, bring that ecosystem along with us. And we are a multi-asset exchange for those who are less familiar. So we offer everything from fixed income, equities, indices, derivatives in equities and commodities, among others. So maybe I could just touch upon the equities and, broadly speaking, commodities. On the equities derivatives space, we launched 5 contracts, key contracts, earlier this year to, they were first of its kind and really to focus on Asia. There were 3 regional ESG products in partnership with Ftse Russell. So the 3 regional ones were relying on Ftse Russell's ESG ratings, one on broadly ESG emerging index futures, secondly on emerging Asia, and thirdly Asia ex-Japan. And the risk return characteristics were similar to the underlying universe, with of course the added benefit of improved ESG metrics and decreased carbon emissions as well, anything between 20 to 26%. And that close alignment to that underlying benchmark indices, we think is still quite important for the market out here to support the ability to build that liquidity in the futures contracts and allow for that seamless adoption by the investment portfolio community as well. The other 2 we had launched, one was called the Ftse Blossom Japan Index, and that wasn't a tilt, it was more looking at I mean, many of you would know that the Blossom Japan Index is quite well adopted. Yes, it was really looking at the best in class selection based upon the, again, quite a well-known partnership with Ftse for Good Index as well. And then the last one that we had launched quite recently was called SGX Nikkei ESG REIT Japan Index Futures. And it was a tilt based upon GRESB scoring. So really looking at geographically, where does it make most sense sectorally, where is it most important, and seeing how can we build liquidity as much as possible. Now, the second aspect on the commodity side, to give a broad overview, it's clear for all of us that the global demand for commodities is only going to be increasing, especially in emerging Asia, where there continues to be growth and modernization of infrastructure, etc.
Is that demand for sustainable derivatives or just more generally?
Generally for derivatives, yes, so I'm talking about commodities, derivatives in general, right? So commodities in general as well, that's growing. But we, of course, realize that there are ways that we must look at greening of the commodities derivatives contracts. So, I mean, just as a base, we offer, contracts including iron ore and steel, freight, rubber, electricity, etc. When we thought about ESG related derivatives products, there were three buckets things would fall into. The first one was sort of like a replacement product, if you'd like. So for example, IMO 2020 compliant low sulfur fuel oil or methanol, for example. Second bucket was complementary products, if you'd like, for higher grade iron ore contracts, so 65% iron ore. And thirdly, then new products to support the growing of the new economy physical, so EV metal or new energy metal contracts. So we will be looking to launch, for example, EV metal related contracts in first half of next year, focusing on cobalt and lithium. We know some of our peers have already looked at these and have launched certain products. But with an expected growth of both cobalt and lithium by anything from 3 times to 9 times respectively by 2030, we believe, including in Asia, is very important that we have these products available. Now, just very briefly, the other two to just mention on RECs, renewable energy certificates. Our subsidiary EMC has been offering RECs for a while already. But what we find is that structuring of the RECs forwards is increasingly something that clients are after. So that's something that we've been offering. And then finally, just on carbon markets. So of course, Climate Impact X is a partnership carbon exchange and marketplace that's to launch. I think it's going to be early next year, in fact. There's been quite a lot of publicity around it. And really, from our perspective, we are leveraging on our track record as a major price discovery venue for global commodities. So we are seeing carbon as a intangible commodity. And yes, so when we think about it from derivatives perspective, now even just the physical voluntary carbon credit market space, if you'd like, that's just being put in place now again, right? So we will, of course, be looking at how do we plan around introduction of carbon-related derivative products in the future. But that will, really to support that forward price discovery and enhancing transparency in the markets. But we have a suite of products that we're looking to launch next year and every few months they're on. So watch that space also.
I think one thing's for sure, we will be watching that space. It's already, as Owen was saying earlier, we have a situation where the report's almost out of date already. One could certainly envisage future editions of it. It sounds, Harry, like there's a couple of points embedded in what you're saying, one of which is that it's very important to have the exchange playing that standardization role because there are so many moving parts when you talk about this commodity derivative or that one. And the exchange as a technical expert working with the market, obviously, but as a technical arbiter, it plays a very important role. Is that how you see it?
Yeah, that as well as that, to create these contracts and a venue for trading, right? It's not just the exchange. You really have to work together with the rest of the ecosystem. And as all exchanges would know, sometimes that is the hardest part, right? So how do you leverage on that experience of building or already having created that ecosystem around you? And then, leveraging on that to launch new products, and really working closely with that ecosystem to make sure you're launching the right products. I think that's actually one of the key value adds that established and existing exchanges can play.
Great. Okay. Well, on that note, I'd like to bring in Kyle Edwards from SIBO, which has been doing its own experimentation in the field of sustainable products. Kyle, what's been your experience? Where's the world going to end up in 5-10 years' time?
Well, thanks, Richard. That's a very big question, and I think it's clear from what everyone else has already said. We don't really know, but it will be, it'll grow. That's for sure. Where it grows to, and what products are sort of the, I guess, the winners. So we don't know, but that's kind of our job to innovate and offer these different in these different areas and work with our partners. And I think that's what, going back to the report and, obviously thank the CME and Owen for their, spearheading that effort, and Siobhan for, taking our SIBO's comments on board as well. That's a very important report. And I think, for us, just highlighting one aspect of it and maybe teasing out some of the things others have mentioned is really just this focus on partnerships. I think it's extremely vital. The idea, excuse me, that we can do something in a vacuum is obviously incorrect. So, we're all exchanges with lots of different, avenues to bring products and different customers, but it really starts there. It starts with, whether we partner with index providers to offer different products, which we do, all of us do in some manner. We're offering S&P 500 ESG index options in the US, an important product for us that we're excited about. We launched that last year. It also extends to, our ETP issuers, in the US. We're, also globally a multi-asset exchange group. So we also are very large in the equity space. Second largest, venue operator in the US for equities. A big part of that is we're also the second largest ETP lister in the US. We also have, expanded that business into Europe as well, where we're, the second largest equities exchange there as well. So really, from our history of derivatives, we've used that as a foundation and to build the ecosystem, as Sarah mentioned, in different ways. And so partnering with index providers, whether that's in a formal way, issuers, and then, in addition to that, just the informal partnerships, the relationship building, the liquidity building that you have every single day throughout for all of your product sets on building that relationship with customers, with asset managers, market makers. It really takes a whole a crew to develop a product that's going to succeed, and that's very important. And then on top of that, a partnership with the SSE and being a full member and partner exchange, those are meaningful partnerships, and they may not you may not see the fruit of those partnerships at the very beginning, and maybe less so for more developed exchanges on this call. But what's clear from the report for us is that the expansion to derivatives exchanges, for example, really demonstrates that exchanges are very different, and we offer very different products, from commodity derivatives to financial derivatives, which is our bread and butter, to the equity space. And so there's a role for us to play, all of us to play, and that's what this report to me really demonstrates in a concrete way, and I think it's been very helpful. But we're really proud of that report as well. And then going on to the product side, I think people have mentioned the products, and we have the index options, ESG index options in the US. We also have the ESG exchange traded products that we're very excited about in both the US and Europe. But what's important that I'd like to just tease out a little more too is what Harry mentioned about the ecosystem. So things that other exchanges can do if they aren't already, and that we're doing in a big way, is expanding that ecosystem in any way we can, whether it's products, but also geographies and capabilities. So, just as an example, what something may not be directly ESG, as Owen mentioned, in different spaces. An example for us is the expansion of our global trading hours in our US markets for index options. Now today, we list our flagship index options products, SPX and VIX options. Those aren't quote unquote ESG, but what that does is expand your global customer base for us. There obviously, we all know, Europe is a leader in the ESG space and globally in expansion. So when you're able to broaden access to those markets as well through extended trading hours for us, it just gives you an opportunity to explore those additional ESG products and onboard those and to access additional customers who are interested in those types of products. And that's really what, in a global marketplace where you can coalesce around a certain product and the standardization that we do offer, and bring that liquidity to the market. So that's one example. Launching our derivatives platform, a new derivatives platform last month in Europe out of Amsterdam. Again, starting out from a foundation of history in the US of options and futures, bringing that to Europe with our expertise, starting with traditional financial non-ESG index options and futures, using that as a foundation to explore those other things. And again, with geographies for us, the recent acquisition of SHIX, SHIX Japan, secondary market equities trading, SHIX Australia, again, equities, but derivatives, warrants, and they've expressed interest. SHIX Australia has expressed interest in operating the carbon market there for the clean energy regulator that has proposed that. So there's just a lot of things that we can do and we are doing to build the ecosystem that isn't, there's steps along that 5-year trajectory that can get you someplace meaningful, wherever that road leads, Richard.
Excellent. It was a tough question, but you handled it admirably. And you touched on a couple of things which have been fascinating me, and which we can maybe talk about a little bit more. Maybe Walt will come in on this in due course. The balance between the extent to which any or all of these markets are more regional or more global in nature. And I suppose there may be variations. Some may be more regional, some less so. But in a world where different standards are emerging, and where we're working towards but haven't quite got to a standard set of disclosures, it'll be interesting to see how global a market this is, and whether there are going to be some contracts that maybe work more on a global level and some on a regional level. But enough of that. Zubin, I'd imagine that you're going through a similar sort of journey. We're on the cusp of really finding out what green equities are and what that means. But do tell us about what your perspective is on where we're going with this market and where the most interesting inflection points are going to be over the next few years, if you can.
Yeah. Good morning, Richard. Hopefully you can all see me and hear me. I had some connection problems in the beginning. I guess at Deutsche Börse Group, we have the full value chain. So we have the cash market here represented by Xetra. We have the derivative markets, namely Eurex, of which I'm an officer, and of course we have the power markets. Oh, do you hear me or not so well?
Yes, there's just quite a lot of background noise. I'm not sure there's anything you can do about it, but it's on the line.
Is that improving things?
That's much better, thank you.
Okay, thank you, Richard. I do appreciate it. So I was just saying, yeah, I think at Deutsche Börse Group we sort of represent the full value chain. We have the cash markets with Xetra. We have the power markets with EEX. We have, of course, my company, so Eurex, representing derivatives, and of course, then the clearinghouse. And I think if I touch upon the first two very briefly, and then I can get a little bit more detailed on what Eurex has been doing. Of course, Xetra here representing primary cash market, secondary market trading. One of the most recent things you will have seen is how we changed the rules, for example, the DAX index. So they're looking at how a G element, so a governance element, can be incorporated into the rules of the DAX, and what it means for primary listing of German companies on Xetra. I'll move very briefly to EEX. Again, EEX I think has been a leader in terms of how they try to decarbonize contracts, looking at biomass and bioenergy contracts. So in terms of the commodity piece as well, the Deutsche Börse Group is well represented. And in coming to sort of my comfort zone and my sphere of expertise, really Eurex. So You know, when I looked at the joint SSE and WSE paper, I mean, I wholeheartedly agree with all of the findings. You know, I think as an exchange, as you put it, we represent the kind of central infrastructure linking all these stakeholders together. I think that really provides us with the responsibility to set the agenda when it comes to ESG availability of products. So we have the right menu of products so that customers have choice. I think that's the greatest power we have, is to offer choice. So when we looked at this, you know, we started on our journey really three and a bit years ago. It was really in research phase. I mean, obviously ESG has been around, you know, a number of years before that. But of course, in terms of researching derivatives, we really looked at a listing strategy which had 3 phases. So the first phase was, you know, we started with a kind of basic negative screening or norms-based screening, which was really, I think, the entry point. There was, by and large, an agreement in terms of standardization as to what constituted, you know, this entry point in terms of adopting UN Global Compact principles, you know, removing controversial weapons, removing nuclear power, white phosphorus, having a threshold of 0 for tobacco producers, thermal coal, and then also looking at what that meant in terms of products. So, you know, you referenced in your report probably our most successful product to date, which is the Stocks Europe 600 ESGX contract. That's been tremendously successful in terms of both sort of open interest. You know, the whole ESG segment at Eurex, you know, this year will have exceeded, I think, 35 billion euros of notional. The open interest will have grown by 200% to almost 5 billion euros at the end of this year, which really places us as the global leader in ESG index derivatives. I think as we look towards sort of phase 2 and phase 3 of our plan, because I think the key thing here is to be well positioned. The challenge, of course, with ESG, as you know, a number of the panelists have mentioned here, is standardization is always the goal, but it's there's a journey to reach there. So it doesn't happen instantly. We all hope COP26 provides a little more clarity there, but in the absence of that standardization, I think you have to be well positioned. You simply have to offer the market choice, and eventually, of course, the market decides. So we have, you know, we have 22 derivatives in our ESG segment. As we've moved into phase 2, you know, we've looked at ESG integration and positive screening. So this is applying ESG scores to companies. Now, once you move in that direction, you move directly in the way of, I would say, in the direction of sort of subjectivity. You know, as soon as you start applying scores, and there's a lot of academic research around the various ESG rating agencies, how there isn't, unfortunately, a one correlation between their scores. Do I think that's a good thing or a bad thing? Neither. I would say the market should be permitted to innovate, especially in this early stage. I think standardization is always a little bit the enemy of innovation, a little bit of the enemy of customization. So I think while we're still in this high growth phase, I think innovation and letting markets sort of find a solution is the right path, I believe. And just to sort of wrap up, you know, what our phase 3 will look like. So phase 3, as we will look to sort of list sort of SRI, so socially responsible investment products, and actually point ourselves towards impact investing. That's much harder to kind of find a benchmark where customers are agreeing, where there's consensus. But here we think, you know, sort of climate transition benchmarks, Paris aligned benchmarks, they're the next wave of important index derivatives that Eurex will list.
Great, thank you, Zubin. That's great, and thank you all who have spoken so far. Walt, you've been waiting very patiently. There's been a lot to digest, and I think that was your cue, because of course you to a very large extent represent the customers of all of these fine exchanges. What do you make of this, and how exactly how much volatility do your members want in this space? Because that's the other thing lurking in here. The derivatives market thrives on volatility. We all want a smooth transition. Where's the sort of balancing line there, if you can possibly answer that question? And what do you make about the way that products are evolving, and the degree to which it may be possible to see some key ones emerge, global versus regional, those sorts of things.
Well, thanks, Richard, and appreciate being here. Obviously, FIA supports the initiative and the report that WFE and the SSE put out. I think you started by talking about allowing markets to be markets. And I think that's where FIA and the members of FIA that are on this panel, that's our expertise, right? It's making sure that markets have the characteristics to succeed, because our markets can help this initiative to make sure we can reach the Paris Accord goals of 2050, but the enormous amount of capital that's going to be needed in order to allow us to meet those goals. And what our markets do very well are discover prices and help people to manage risk and move capital to where it needs to be, from those that have the capital to those that need the capital. And so if we can build this right, we can work in partnership with the governments around the world who are leading these efforts to help find the solutions that are needed to get us to where we need to be with the Paris Accord. There's an enormous amount of efforts in order to get us to those goals of inventions that haven't even been invented yet, that capital is going to have to get to in order for this to work. So we have a long history in the derivatives markets of helping on these esoteric products. Obviously, we are good at pricing interest rates and equities and commodities, traditional commodities. But I remember early on in my career, when I first moved to Chicago, I ran into Richard Sander at a conference talking about sulfur dioxide and how the acid rain problem in the United States was just causing all sorts of health issues, and millions of people were dying from this. And through an offset program similar to what we're trying to build with carbon, that they were able to solve for those issues. So our hope is that we can, again, how do we build markets that can be successful? And so I think what the report does very well is lays out the characteristics of how markets can succeed. And so whether it's transparency, making sure there's standardization, making sure there's regulatory harmonization. And that's really where FIA has focused our efforts. So we've been not only involved in the initiative, but also scaling voluntary carbon markets, the Mark Carney initiative, making sure that, we are, getting to where we need to be on those efforts. I think from a market standpoint, there are a lot of folks involved in that effort, NGOs and people who are much deeper expertise on climate change issues than the FIA and its members. But where we can add value is to talk about how the existing infrastructure can benefit those efforts. And there is an enormous amount of existing infrastructure that's going to help move the needle on developing those voluntary carbon markets, on listing more sustainable products. You're already hearing about the innovations that are happening, among our membership here on this panel today. I think we estimate, and this is, as I think Owen mentioned, that so much has happened even since the report came out, but there are over 100 sustainable products now listed on exchanges in various forms, on derivatives exchanges. So, if we think of the three pillars of what we're trying to do at FIA, it's really innovation, harmonization, and standardization. How do we get out of the way of the marketplace to allow this innovation to happen, and for these prices, to be discovered, so that capital can get to where it needs to get to. You mentioned volatility. If I understood and knew and could predict where the volatility was, I would be doing something else. I would be investing and not a trade association. But the nice thing about our markets is it does allow people to manage for that volatility. And so people who want to hedge that risk, there will be products that will allow insurance companies and others to come into the marketplace to manage that transitional risk. There's going to be significant types of assets that are stranded as a result of this, as we move from dirty energy to cleaner energy. our market's going to help with that, to make sure we're pricing things to make sure investments are happening where they need to be. I was at the Commodity Futures Trading Commission as its head in the late 2000s when oil prices went to over $147 a barrel. I remember those days. I was testifying before Congress quite a bit. But what happened when our markets started to discover those prices? The United States went from a net exporter of the largest net exporter of or importer of petroleum to within 5 or 6 years of the largest net exporter of petroleum, because prices were being discovered and capital was being put to where it needed to help clear those prices. And so I know it's ironic me talking about petroleum during this segment, but the truth is we're going to get similar pricing on clean energy, on sustainable products that are going to drive capital investment to where they need to be, to those innovations and those great products that our free enterprise system is going to allow us to invent. So I'm very hopeful. Like I said, I'm here to sort of represent how we get to successful markets, and all the great ideas on this panel, I think, are evidence that it's on its way and hopefully will help in the transition to 2050.
Thanks very much, Walt. Those were truly profound comments. I'm glad you focus not just on the standardization, but on this continuing challenge to be, I would say, nimble. And who knows, maybe some of these products we've been talking about will evolve, and maybe other variants will come along, and that's all going to be part of the fun, part of the challenge, I suppose. I must just pick you up on regulatory harmonization. You're presumably not talking about purely within the US.
No, absolutely. I think, like all markets, and a lot of us are involved in the standardization efforts, but these are going to be global benchmarks. They're not just going to be regional. There will be some products that are regional, but many will be global benchmarks. And you're going to have customers from around the world accessing markets outside of their jurisdiction, and with regulators that are overseeing those things. So we want to make sure that the normal standardization around regulation is happening, that markets are safe, that people feel confident that they can invest in things around the globe. And there'll be a coordination among regulatory agencies around the globe through IOSCO and other efforts to do those things. So that's going to be important. I think the language of how we speak about these things, the taxonomy, is enormously important. Something that Europe is already doing, but there's going to be a lot of efforts to make sure that we are speaking apples to apples around the globe on this. So there's going to be an enormous amount of energy spent making sure there's harmonization there. So that's a very important component that we need to be aware of and be active as an industry, making sure that harmonization is there. I would say, one positive thing, unlike many markets that develop in silos, there is an early collective effort. We're already gathered as an industry and as a regulatory world on this issue. There's a uniformity already to try to get that harmonization up front. So I think that is a positive sign. Most of the time, the markets have developed and we're working on harmonization afterwards. So I do think it's nice that we have this a little more upfront than we do in typical markets.
Yeah, amen to that, and we'll spend the energy and make sure it's sustainable energy, of course. Thank you, Paul. Siobhan, given your role in producing the report and what you've heard today, do you have any questions to any of the other panelists? Are there any observations you'd like to make about what this discussion has added to the paper itself and where we could take the discussion in future?
Sure. Well, let me pull out a few things that I think are heartening and interesting for how we think about things going forward. So the heartening is the paper is already out of date. And as somebody who put a lot of blood, sweat, and tears into that shouldn't be a good thing, but actually it's fantastic. rip out the executive summary and the action plan, that's still relevant, but the list of products has grown exponentially. And I think that's astonishing and is a testament to the people on this call and others who are working on this. And then two other things that comments I've heard, which I think are relevant in the context of this conversation and how this will evolve. One, we're in the midst of a transition, right? It is a significant transition. Whether we get to 1.5 or not, the world by 2050 is going to look very different to the world we live in today. And what markets do well is help manage transitions, derivatives markets particularly, right? So providing the products and services that help get us through the next 30 years, it's not time bound in some way, the world doesn't end then, but is, I think, critically important. And it's very heartening to see everyone stepping up and taking on that role. And then I think the other point is the point that Kyle raised around partnerships, which is, we all know that these things, that exchanges have to work with partners, with ecosystems. And I think the nature of the ecosystems and partners that exchanges are going to be working with is going to evolve, right? So when we start to talk about standards, you're not just talking about market standards, you're talking about, well, what's actually effective from a climate mitigation or adaptation perspective. So that's climate scientists, NGOs like the guys behind SBTI. We're starting to talk about nature-based solutions and the impact of nature. So a whole bunch of academics and NGOs and others who are new partners that exchanges and others are going to be starting to engage with as we think about the next period. So I am hopeful that we've got this in hand. And so I'm going to leave it there and leave the last remark to someone else.
Thank you, Siobhan. Yeah, sorry, but yeah, we'll have to. This is. I think the report still has some shelf life. I wasn't trying to say we should be tearing it up, but yes, it is a good sign, isn't it, that we've really touched. We've hit a rich seam here. I mean, to my mind, and I'm going back to my earlier point, talking about having worked on and in and around derivatives, it seems to me there's a real opportunity for derivatives to do what they have done in other bits of the financial world and actually act as at least an equal partner in price formation, if not the lead. We know that in commodity derivatives, this is not an unusual pattern, that the spot can be priced off the forward price. The challenge, I think, and we've got very little time left, so it should really be wrapping up, but the challenge, I think, will be extending the tenors so that some of these customers can hedge or take positions out a little bit further into the future. Picking at random. Oh, and is that a fair comment? Is that going to be the next frontier for?
Yeah, absolutely. I think the presence of a forward curve is one of the most important aspects. Even if that trade isn't super liquid on the forward curve, the fact that there's a price signal that tells a carbon developer that it will be profitable to develop an offset project, or the fact that the forward curve tells a bank that it's worth financing a new cobalt or lithium production facility, that's really massive. And that's something that we just didn't have a year or two ago. So totally agree with you.
And one very quick question for Harry, if I may. One of the things that was sort of implicit and maybe a little bit more in your comments was how useful it can be to have maybe not a full one-stop shop, but to be able to bring a number of different products together in one place, a number of different products that are sustainability focused, but also things that are not necessarily sustainability focused, because at the end of the day, one is going to be dealing with the same customers who are moving to a more sustainable approach. I'm guessing that that's a pretty important part of an exchange's strategy in the space.
Yes, and I think a lot of, in particular when it comes to climate transition and energy transition, which is going to be a big part of climate transition, all of these discussions are currently bubbling up or starting to bubble up under the Net Zero Financial Services Providers Alliance, which you just recently launched, and we were one of the 12 founding members. And it's not just exchanges, by the way, it's exchanges, it is credit rating agencies, there are ESG rating agencies, investment consultants, etc. And really to think through, in particular for exchanges, and this is where we'll be working with SSE as well very closely, what does that transition mean across the different business lines of an exchange when we have such an important role to play in providing that transparency and signal, right? Pricing signal. If a market that is seen to be brown today, if all of that was to become OTC, is that going to be helpful actually for that transition, right? Not to say that for exchanges that are still deriving revenues by 2050, that's probably not the way we want to go. I think exchanges also have to think about what is that broad transition plan that we have to put in place. And that's where we thought through, what is there to replace, what is there to build as new contracts, and what is there to sort of support the existing, right? And again, then that's where that close collaboration with the ecosystem and partnerships and really understanding where is the market going, it's going to be so important. Is it enough for us to just say, let's just go with the flow and let the market decide? I don't know, these are some of the tough discussions that we as exchanges need to have in the coming months and years.
Yeah, I suspect very few innovations happen in a darkened room by somebody sitting on their own. It is all about that, coming together of thoughts and ideas and perspectives. Any last thoughts, Kyle, Zubin? Anything you would like to add that you forgot or have been inspired to say by the discussion in the last few minutes? Kyle?
Well, I guess going back to something Siobhan said, is just on the partnership idea and sort of expanding the types of partnerships we're going to have. I think that's absolutely critical, but also just to reinforce that a lot of these ideas come from our own feelings about what we should do as a corporate entity as well. So I'm also involved in my own ESG program and expanding to and thinking about net zero from that perspective as well. And really some of those partnerships and ideas that we're thinking about on the product side are coming from that side, because we see the demand from ourselves and we see where we're going, and we can see where others probably want to go to that may not know how to get there. So I think it's a self-fulfilling prophecy in a way, or a loop, and it's all very important. So I just want to thank you, Richard, and thank all the other panelists as well. This has been very, very interesting.
Yeah, thank you, Carl. Yes, when you have to do something yourself, you suddenly realize that what it entails. Zubin, last chance for a quick comment from you, and then I think we have to wrap up.
Yeah, thank you, Richard. Very quickly, I'll just say, look, call to action. So if there's any members of the audience who are portfolio managers, asset managers, of course, is to really look at the segment Eurex has. We spend a lot of time developing the liquidity, and of course, you only get the growth if the end customers utilize the product. So I guess that's the call to action. And then a sort of related point is, again, any audience members, if they happen to be looking at developing ESG products, the research and the product design team we have here at Eurex are always highly interested in taking those conversations, and bringing products to market.
Great, that's a very nice spot to end. I thoroughly enjoyed moderating this panel. It's I have moved up the learning curve. It's been really, really interesting. I'd like to thank everybody for making it such a pleasure, as well as so interesting to run this hour. Thank you very much all, and good luck to all of you in all your endeavors. It's going to be an interesting thing to compare with where we are in maybe a year or two's time. And with that, I'm going to hand back, and thanks again for the invitation to moderate. It's been a great pleasure.
Thank you very much. Bye-bye.
Thanks, Richard.
Goodbye.
Okay.